Ladies and gentlemen, good day and welcome to Trustline Advisors LLP investor call for AIF Fund. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arunagiri, Founder, CEO, and Chief Investment Officer. Thank you, and over to you, sir.
Thank you. Hello, everyone. Very good evening. Thanks a lot for participating on a mid of a week on a working day. We really appreciate that. For those of you who have joined this call for the first time, for the AIF call for the first time, wanted to just give a bit of a context to this call. The reason why we do this call is to bring in transparency to our investor communication. We do send our regular quarterly newsletters and as well as monthly biz notes to all of you. Some of you must have had an opportunity to go through it. This call is primarily to build on that and give an opportunity for investors to understand our strategies and then our current view on the market, and more importantly, how we are placed in terms of portfolio performance for the coming quarters. That's the kind of a backdrop. And in terms of structure, I think it is the usual structure what we follow. Initial 15-20 minutes, we will do it will be opening. We will cover the opening commentary, which will cover about market views and then portfolio highlights, portfolio actionables for the last quarter. Then follow it up with a Q&A. That's the plan, and we would like to wrap up this session in max 45 minutes. And we've done a small change with respect to the market view. In addition to giving generic market view for the current market view, we would also like to pick a couple of interesting developments which happened in the recent past and talk about the implications so that the investors have an opportunity to understand and get some insights on these developments which are with respect to market development. So that's the plan. As far as the markets are concerned, it had a big run for the last few months, especially for small mid-caps starting from mid-April. If you look at the FI flows from June, July, August, each month they had pumped in close over $5 billion in every month. And so that triggered a big rally in Indian markets, especially small mid-caps had a bull run. Of course, with that kind of a very impressive run, it's a matter of time before, it started cooling off. And that's what we started seeing in September. What is interesting is, in an unusual way, a lot of, some of the factors converged to put a brake on the market momentum starting middle of September. Let me explain what caused this. It all started with Fed signaling its intent to keep the rates elevated for a longer time, prolonged period, than the market was initially pricing it or market was factoring in. That triggered a rally in the yields, 10-year yield, 5-year yield, 2-year treasury yield in US, which in turn triggered a big rally in dollar index. For example, mid-September to now, dollar index, which used to be around 103, is now near 107. And yields, 10-year yields is now inching towards, it's almost near 5% and probably it will move beyond 5. So that was a perfect setting. The picture was complete and the global markets were on a spin. India was not an exception. Of course, India didn't correct too much, but it did take a pause. But the critical question is whether this pause will lead to a brief lull or consolidation or it will lead to a very steep correction. It's very difficult to say, but at this point of time, given that, macro stability and given the attractive growth cycle for India and given the potential inflows from the bond inclusion, JP Morgan's index bond inclusion into the debt market starting next year and the kind of domestic support market is getting in terms of domestic flows, it looks unlikely for a severe price correction, but one can't rule that out. But having said that, given the lofty valuation in which the markets are trading now, one should expect kind of an extended time correction, if not a price correction. That is something one can't rule it out. And it is also interesting, it's critical to keep watch out for the increased volatility as we near the election cycle. This is the kind of, I would say, is the generic market view. Now, moving on, in terms of two recent developments, what I would like to pick is, the first one is on the JP Morgan bond index inclusion. Most of you must have read about this. This made a lot of news in the media. JP Morgan recently announced that it is going to include Indian government bonds into its index starting from June 2024. And people expect a lot of flows because of this into debt market, into government's GSEC market. And most of the media attention, much of the media attention has been on the quantum of flows which India would attract. Of course, it's going to, it is going to have an increased flows in terms of debt flows into Indian markets. Our topic, we are not going to be talking about that. What we are interested in, what I am going to be talking about is a different perspective in terms of how it is going to bring in kind of accountability and fiscal restraint on the government, on the future political regimes. So to understand that, one need to look at what kind of risk the potential outflows from, debt markets or the bond markets can have on the currency and money market. So for example, let's hypothetically assume that we receive about $50 billion because of this move into GSEC market over the next 2-3 years, right? And that's not an unreasonable assumption. Now, because of some macro instability fears, even a small part of it, let's say about $10-15 billion, moves out very quickly in a very disorderly fashion. It can create a devastating impact on the currency and money markets. This potential event risk, the macro risk, is in our view is the biggest check and balance for future and current political regimes, political administration, because in India, political administrations have the tendency to yield to, political largesse as well as for populist pressures. So in that perspective, this is one of the biggest reforms India has seen. It will bring much needed accountability and fiscal scrutiny into Indian, macro metrics. Even if you assume that India, if we are to have a coalition kind of a formation at the center in the next election cycle, even if you had assumed that, given the macro instability fears, it will act, this potential, event risk will act as a deterrent for any of those partners to do, try out any misadventures. That is one aspect of it. The second aspect, which is more interesting, is we have seen in the past, some of the ministers in the North Bloc, tend to publicly state that they don't lose sleep over stock markets, right? We have seen this kind of irresponsible announcements from some of the political leaders. While they can get away from such statements about stock market, it is very, very hard for them to get away with the similar statements on money or currency markets, because it will hit them where it hurts them most. Because the spillover effects of currency into inflation and interest rates. And inflation is a hot button, and it hits, it hurts the common people, and as a result, it will be a hard pill for to swallow for political masters. So in summary, basically in our view, it's hard to find any other reforms which are more significant than this particular one. Of course, the exception is full capital account convertibility. That will also bring in a huge, accountability to Indian macro. Leaving that, I think this is one of the biggest reforms, and it is going to bring in a lot more fiscal restraint, fiscal scrutiny, and accountability for Indian administration. So in that aspect, this is one of the very, very significant development, not much appreciated outside. I have covered it in my piece in Economic Times recently. So this is one thing which I want to discuss so that people really understand the implication for the India macro. And given the current stage of Indian macro, given this kind of accountability which it brings, and it's not going to stop with only JP Morgan, a lot more global indices will start including Indian government papers into their index, which means more accountability for India macro, which means we are going to be seeing much more interesting period for Indian macro. So that is one aspect of it. Second aspect which, second development which I want to discuss a little more detail so that we make this opening commentary a little more interesting is the, kind of trends which are happening on domestic flows. I have covered this in many of my writings. There is a huge shift, structural shift which is happening on domestic flows. Just take the number of DI asset under management and FI asset under management. As we speak now, the DI asset under management stands at about $615 billion. FI asset under management is about $650 billion. Less than 5% the difference, or little over 5%. Now the same number used to have a difference of 30% just about 2-3 years back. So that's one development one has to keep in view. This is one of the data point which I want to share. Second is the SIP folio, new folio which are getting opened, SIP, new folios, which used to be about 1 million a month just before, 2-3 years back, is now clocking about 3 million. So, and in terms of net SIP inflows, cumulatively for the last 5 years, if one looks at it, net SIP inflows are now almost 55 to 60% of the net MF flows. And they are at about 50%, 45% to 50% of the gross DII flows. So, which means it brings a lot of stability to the market. And we are already seeing that significance in this current quarter itself. Let's look at now what happened post September 15th and 19th. The rates are going to be elevated. Global markets went on a spin. And FIs pulled out in September about $1.7 billion. October, as we speak, already $1.5 billion has gone out almost, which means we have net about $3 billion has gone out from the time of September to October, middle of October. The same time, look at the domestic flows. It is about $4 billion. DII flows, which includes SIP, mutual funds, and insurance, and banks and pension funds. So that is the significance one can already see in this quarter. And look at this, how it reflects in terms of our numbers. MSCI EM index has done minus 0.5 in terms of dollar returns for the YTD. And India, look at it, it's 8% plus. So it's already showing a lot more markets are correcting given the global uncertainty in macro, whereas India is withstanding because of this one big shift which is happening on domestic flows. And it's not going to stop here. As we see it, given 30-40 billion of dollars of flows yearly, from domestic because of insurance and mutual funds, you will start seeing this becoming much more prominent compared to FI, asset under management, if not in the next few months, at least in the next, few quarters. This is another significant development. Investors should know that's the reason volatility is coming down, and in spite of global, challenges, India is a lot more resilient. Even today, if you look at Asia markets, have corrected significantly, whereas India has withstood and you have very marginal correction. This is one thing which I want to point out. So with this, I think I come to the end of market commentary. Thanks everyone for patiently listening to our opening commentary, and thanks for the participants for very interesting questions. Thanks a lot, and I look forward to our next call after 6 months. We do this call every 6 months, alternately for PMS and for AIF. So the AIF call, the next one would happen after 6 months, and we look forward to that. Thanks a lot, and thanks once again for the participation. Thank you.
Thank you very much.
Thank you.
On behalf of Trustline Advisors LLP, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.